Um, we are representing Westminster College, the Gore School of Business. Kuchana Punarith, Oscar Bello, Luis Chavez, Chris Nassi, myself, Michael von Balmos. In this particular case, we're acting as representative of Investment Bankers LLC, reacting to a project endeavor from John Doe, a board member of Chinos. He tasked us to react and give our proposal to ATL's offer of $20 per share. First, we're going to give a little bit of a company overview. Then we're going to take a top-down approach from economic overview and industry overview down to the details of our evaluation approaches. Let's get right to it.
Starting with the, sorry, your mic clicker. Starting with a little bit about the background behind Chinos, we know that it is a men's casual retailer operating in the men's clothing industry, that the current CEO, Juanita Martinez, is currently reaching retirement age and has expressed interest in remaining on the board for future years, that her son, Chief Operating Officer Max, is also interested in becoming CEO should Juanita decide to step down, and that Juanita considers Max her natural successor. There is currently a developing partnership between the legendary rapper Southeast and the firm Chinos to develop a new brand of leather jogging shorts. And finally, the current stock offer price for Chinos is currently languishing, according to the report we received from you all, from Chinos board members, at around $12 per share. Moving forward, some of the plans that have been discussed are the acquisition of a firm called Boots Electric, a Canadian-based boot company, which Chief Operating Officer Max believes can be acquired for an EBITDA increase cash flow to the tune of $35 million. He believes that this will help raise brand awareness, increase consumer sales, and also help promote the brand of Chinos. Moving into the macroeconomic outlook for Chinos, GDP growth is forecasted to increase since the Great Recession of 2008, with recent data supporting sustained growth throughout 2014. In the graph shown, we can see the actual GDP forecasts provided by the Federal Reserve Bank of San Francisco. GDP growth is a key driver for industry growth. What this means for Chinos is that the company's growth and revenues are expected to grow in tandem with industry forecasts. Indicators helping to forecast this growth are the recovery of the housing market, rebounding consumer and government spending, and the relaxation of federal fiscal policies. Unemployment has steadily decreased to 7% and is expected to decrease gradually over the next several years. Consumer attitudes are also shifting as they see prices falling, an increase in their discretionary income, and a recovering economy. Per capita disposable income translates to an increase in discretionary spending, which will expand Chinos' bottom line as more consumers find themselves with the means to buy highly elastic goods such as men's casual wear. Falling unemployment helps drive demand, as more men enter the workforce and therefore require more professional and casual wear. This complements well the increase in disposable income, which gives them the means to do so. Looking at the industry analysis, the men's clothing and retail industry is forecasted to grow by 3.1% annually into 2018. This comes after a sharp decline from 2009 to 2014, with the industry contracting by 0.3% annually, as seen on the left-hand side of the graph. Because of the expected macroeconomic outlook previously mentioned, analysts are forecasting an industry turnaround. We will now move to the valuation portion of our presentation. For the following valuation approaches, we use Chinos' income statement and balance sheets to formulate management's projections. We have Chino's projection as a line graph with the years represented by the x-axis and the thousands of dollars represented by the y-axis. On the left side of the graph, we show Chino's actuals and estimates from 2011 to 2013 on the left-hand side, and projections for the next 6 years from 2014 to 2019 on the farther left-hand side. This is expected to grow at a rate of 4 to 6% year over year. Despite historical decline in revenue, we assume management has incorporated into its plan to increase brand awareness, sales, and margins. And then just jump to operating margins. We'll cut this out. Operating margins are also expected to increase from 2.4% in 2013 to reaching its peak in 2017 and leveling out to about 7.1% in 2019. On average, the rate is increasing annually at a rate of 5% per year.
That's the validation thing. All right, so because of Chino's, the what? All right, because of Chino's high expectations of growth and because of Chino's high expectations of sales and industry growth, we can see that the free cash flow projections show an aggressive growth from 7 million in 2013 to 33 million in 2019. We used a traditional discounted cash flow method to value Chino's at the end of 2013. We used a comparable company weighted average cost of capital as one of the discount rates. We also calculated two costs of equity using the build-up method and the CAPM method. The inputs for the build-up method, we got the risk-free rate from a 20-year treasury bill of at 4%, an equity risk premium of 5%, an industry risk premium of 1%, and a size premium of 6% to give us a cost of equity of 16%. And for the CAPM method, we use the same 4% for the risk-free rate, accompanied by a 1.2 beta and a market return of 12%, giving us a cost of equity of about 14%. And for the weighted average cost of capital, For the weighted average cost of capital, we consider the weighted average cost of capital considers Chino's value of debt at 27% and the cost of debt at 7%, as well as a tax rate of 34%. And using the cost of equity from the build-up method, we get a WACC of 13%. And using the cost of equity from CAPM, we get a WACC of about 11.5%. And using the three different WACCs and the long-term growth rates between 2 and 4%, we come to a range of, for an enterprise value of $240 million and $330 million. But the enterprise value that we're putting our hat on for Chino's, or the enterprise value we're putting on Chino's is the $284 million. And using that enterprise value after accounting for debt and cash, we come to a price per share of about $26.
Ready to twist? Yes. If all of this holds true, we come up with a per share price for approximately $26 per share. But as you may have seen in our previous submission of video, on video, we believe that some substantial haircuts must be made in order for the value to be realistic. First, Chino is currently underperforming its competitors on operating margin.
It's also heavily leveraged compared to its peers with an equity ratio of about 3 times.
And it's underperforming industry sales growth.
Moreover, Mac's new partnership with Southeast has yet to prove that it will add any value to the firm.
Chino's CFO, James Fronter, thinks Quantia and Mac's forecasts are wrong and a decline in sales and EBITDA is more likely.
Not even the board is convinced that Max is the ideal successor for Quantia as the CEO.
And we consider a potential acquisition of Boots Electric. However, the information is too preliminary to estimate the added value, and don't forget the upfront cost that must be incurred for such an acquisition.
The fast turnaround that Chino's analyst projects, we believe is very unlikely. Going from underperforming the industry with low margins and declining growth to a hockey stick trend?
Well, not one comparable company pulled off what Chino's is projecting.
Hey guys.
All of these points that you see are reasons why Chino's forecasts can't be taken at face value, and adjustments have to be made. Let us now go into a little bit more detail on the aforementioned points. Take it away.
So cool. Just pause this real